So, what if I told you that the matching rule you probably trust the most, like the exact down to the penny one-to-one match, is actually the exact thing breaking your automated bank reconciliation?
I mean, it sounds completely counterintuitive, right? For decades, accountants have been, trained that a perfect one-to-one mirror between the bank statement and the ledger is the absolute gold standard of financial accuracy.
Well, it's like accounting 101.
Exactly. But when you step into the real world of corporate finance, relying strictly on that manual, one-to-one methodology turns month-end close into this massive time-consuming puzzle.
It really does. And, if you are a Dynamics 365 consultant or maybe a controller or just a power user listening to this right now, you know exactly the drudgery we are talking about. You're looking for an escape route from manual bank recs.
Oh, absolutely. Everyone wants out of that manual grind.
Yeah. So our mission for this deep dive is to unpack the mechanics and the strategic value of the advanced bank reconciliation feature in Dynamics 365 Finance. We're basically treating this as your ultimate cheat sheet for transforming how your financial operations actually function.
And, we really should establish the core why before we even touch the system configuration. Moving to advanced reconciliation, it isn't simply about saving your accounts payable and AR teams a few hours on a Friday afternoon.
Right, it's bigger than that.
Much bigger. It represents a fundamental structural shift in how clean financial data is processed, validated, and permanently managed within your ERP. You are basically shifting from data entry to data orchestration.
Data orchestration, I love that. And to map out that orchestration today, we're pulling from some highly technical sources. We're looking heavily at a really comprehensive configuration guide engineered by Jordan Soderstrom over at Stone Ridge Software.
Yeah, that guide is fantastic.
It really is. And we are cross-referencing that with the official Microsoft documentation covering electronic reporting, Dataverse architecture, and system administration. But, you can't automate the matching process until the bank's data physically lives inside D365.
Right. You need the raw materials first.
Exactly. Which brings us to the very first major decision point, which is choosing your import format. Okay, let's unpack this.
Yeah, so this is the gateway to the entire process. Microsoft provides 4 out-of-the-box options for importing bank statement data. And 3 of these utilize the electronic reporting framework, which we usually just call ER.
Okay, so what are those 3 ER formats?
Well, you have BAI2, which is heavily dominant in North America. Then you have MT940, which is the standard across Latin America and Asia. And finally, you have CMT-POT 053, which is the universal standard over in Europe.
Got it. It's kind of like picking the right plug adapter for international travel, right? You just match the format to the region.
That's actually a perfect way to look at it. You have to match the plug to the wall.
But wait, you said there were 4 options. What's the 4th one?
Right. So the 4th is the Data Management Framework, or DMF. That is your standard Excel or CSV file import.
Okay, so wait. Why would anyone choose a manual CSV if the bank offers a standard, automated BAI2 file? Like, if they offer that directly into the system, why use a CSV? That feels like stepping back into the Stone Age of accounting.
It does feel pretty regressive, I'll give you that. But the banking landscape dictates the technology. The underlying reality is that thousands of smaller regional banks or specialized credit unions, they simply do not possess the architectural capability to generate a structured electronic reporting file.
Oh, interesting. So they just physically can't produce a BAI2.
Exactly. They just don't have the tech for it. So in those edge cases, the DMF method using a CSV, it isn't a choice. It's a hard necessity. The best technology is just the one that actually matches the bank's capabilities.
Okay, fair enough for the small banks. But what if I am consulting for a massive enterprise? Let's say they use a tier 1 global bank that definitely supports BAI2. Is there ever a strategic reason to use a CSV in that scenario?
Oh, absolutely. And it usually comes down to complex legal entity structures. Imagine a scenario where a corporation has a single massive physical bank account. But inside D365, they operate 3 distinct legal entities that all share that one physical account.
Ah, okay. So the raw statement data coming from the bank has the transactions for all 3 entities just completely mixed together in one file.
Precisely. It's a giant jumble. If you attempt to automate that by pulling a raw BAI2 file directly into D365, the system just chokes. It doesn't inherently know how to parse a single continuous bank text block across multiple distinct F&O legal entities.
That makes total sense. So the CSV gives you a buffer.
Exactly.
Yeah.
By using a CSV format, your controller has the opportunity to manually intervene. They open the spreadsheet and they physically split the rows by legal entity before the system ingests the data.
Okay, so getting the data format figured out is really just the blueprint.
Yeah.
Because actually wiring it into D365 is where the first major technical roadblock hits. I was reading through the Stone Ridge guide, and there is a massive infrastructure catch regarding those automated ER formats that apparently trips up a ton of implementation teams.
Oh, you are referring to the environment tier requirements. Yes, this is a very critical hurdle.
Yeah, it blew my mind a little bit.
It surprises a lot of people. To utilize any of the ER formats, BAI2, MT940, or CAMT, your D365 finance setup requires an active connection to the Dataverse to access the ER repository.
Right.
Consequently, this makes a Tier 2 F&O environment, or higher, strictly mandatory.
Which is wild to me. It's like buying a high-end appliance only to realize your house doesn't have the right electrical wiring to plug it in. Why does Microsoft care what tier environment I am in just to import a bank file?
It is frustrating, but it comes down to the underlying SQL architecture and how Microsoft handles cross-platform authentication. A Tier 1 environment is fundamentally a single-box architecture.
Okay, so it's just too basic.
Right. It lacks the Azure-backed microservices and the dual-write infrastructure that's required to natively query the global ER repository.
And dual-write, just to clarify from the sources, that means the continuous bidirectional syncing of data between finance and operations and the customer engagement apps, right?
Correct. Microsoft is really positioning the Dataverse as the central nervous system for all enterprise data. Because the complex electronic reporting configurations physically live in the Power Platform's global repository, D365 has to authenticate outward to retrieve them.
And a Tier 1 environment just physically cannot make that handshake.
Exactly. It can't reach out. Furthermore, even in a Tier 2 environment, you have to go into the Power Platform Admin Center and assign a very specific security role to your users.
Oh, right, the ER repository role.
Yes. If you miss that step, D365 will just throw this generic request to Dataverse failed error, and your automated import just stops dead in its tracks.
That is such a huge gotcha for consultants. Okay, so the data import relies entirely on getting the Dataverse security and the environment tiers perfectly aligned. Let's assume we have successfully navigated that infrastructure.
Okay, pipes are connected.
Right. Tier 2 environment is good. Dataverse is connected. The BII2 files flowing in. But D365 and the bank are essentially speaking two completely different languages at this point, right? How does the system act as a translator?
This is where the configuration logic really begins. It starts internally with bank transaction types. Before you can match anything, you have to create a unique identifier in D365 for every possible category of transaction.
Like electronic deposits, physical check payments, wire transfers, NSF charges, things like that.
Exactly. All of those.
And according to the sources, a critical best practice here is to default those bank transaction types onto your methods of payment.
Spot on.
So when a customer pays an invoice via ACH, D365 inherently tags that ledger entry with the electronic deposit transaction type automatically.
Right. That internal tag gives D365 a known variable. But the problem is the bank's data doesn't contain your internal tags. The bank file is populated with standardized numeric codes.
Which just looks like gibberish to the system.
Exactly. It's just numbers. This requires transaction code mapping. You have to explicitly instruct D365 what the bank's numeric gibberish actually means. For instance, in a standard BAI2 file, the numeric code 475 is almost universally used to indicate a physical check payment.
Okay, so you just map statement transaction code 475 directly to your internal check bank transaction type.
You got it. And once you do that, the system finally understands what it's looking at. The data is translated.
Okay, here's where it gets really interesting. Now we need the system to actually match the bank statement line to our internal ledger line. Which brings us back to that provocative hook from the beginning of the deep dive, the matching rules and the hidden danger of the one-to-one match.
Right. So the one-to-one matching rule is the most fundamental logic you can build. It tells the system, if the bank statement shows $500 coming in on Tuesday and the D365 ledger shows $500 coming in on Tuesday, pair them up.
Wait, if one-to-one is the safest, most accurate match, like the exact penny on the exact date, why on earth would I want the system to ignore that and run more complex, fuzzy rules first? That just sounds incredibly risky.
Because a basic one-to-one rule is completely blind to context. If you run a high-volume financial operation, you might have 20 different transactions for exactly $500 clearing on the exact same Tuesday.
Oh, I see.
Yeah, you might have a $500 vendor payment, a $500 customer deposit, and, I don't know, a $500 employee expense reimbursement.
And they all look identical to a basic rule.
Exactly. If you put the one-to-one rule at the top of your hierarchy, D365 will blindly grab the very first $500 it finds in the ledger and pair it with the first $500 on the bank statement.
It just pairs them based on the integer, regardless of what the transaction actually was, and suddenly your ledger is completely corrupt.
Exactly the problem. It causes absolute chaos. This is why the sources are so adamant. The one-to-one default rule must be placed at the very end of your rule set. It functions purely as a catch-all.
I like to think of it like a bouncer at a really exclusive VIP club.
Okay, I like where this is going.
Right, so the specific complex matching rules are the bouncers standing at the front door holding a clipboard. They are actively searching the crowd for the VIPs, the highly specific nuanced transactions.
Oh, that's good.
They pull the VIPs out of the crowd first. And then, once all the complex matches are safely inside the club, the one-to-one default rule is just the general admission line, letting the rest of the standard, easily identifiable matches flow through.
That analogy perfectly captures the sequence. By forcing the one-to-one rule to the bottom, you give the system permission to execute your strategic multivariable rules first. And honestly, this leads us to where the massive time savings actually happen, which is many-to-one matching logic.
Yes. Let's really focus on that mechanism because this solves one of the biggest friction points for any accounts payable department. Give me this scenario where many-to-one is required.
The most common scenario by far is a Vendo ACH batch. So in D365, your accounts payable team might post individual payments to 5 different vendors on the same day. Let's say 5 separate checks for $1,000 each.
Okay, so D365 generates 5 distinct $1,000 ledger entries.
Exactly. But when that payment file is transmitted to the bank does not process it as 5 individual withdrawals.
No, the bank processes as a single ACH batch. When the bank statement comes back via that automated BAI2 file we talked about, it shows a single summarized withdrawal of $5,000, usually categorized with a BAI2 code of 469.
You've got it. And historically, an accountant would have to look at that $5,000 withdrawal, literally pull out a desktop calculator and manually hunt down the 5 $1,000 ledger entries to verify they match.
Sounds like a nightmare. But with many-to-one matching, you instruct the system to do the hunting for you.
Exactly. You configure a rule that says, take all the unreconciled F&O posted transactions tagged as electronic payments, group them together by date, and look for a single imported statement line with code 469 that matches the total grouped amount.
And you can apply a date tolerance to this rule, right? Typically like a 1-day or 2-day window because the date you post the journal in D365 might actually precede the day the bank clears the batch.
Yes, the timing is rarely perfect, so the tolerance is key.
But wait, if you are grouping dozens of transactions together and giving the system a fuzzy 24-hour window to find a match, aren't you just begging for massive false positives? Like, what if I process 2 entirely separate $5,000 payment batches in the same week? How does the system know which ledger entries belong to which bank batch?
That is the exact fear most controllers have when they first implement this. But what's fascinating here is how the layered logic acts as your safety net. The system isn't just looking at the fuzzy date and the amount.
It's looking at tags, right?
Exactly. The rule specifically requires that BAI2 code 469. Furthermore, the rule is restricted to only evaluate specific bank transaction types inside D365.
Oh, I see.
So by requiring the bank's specific code, your internal transaction type, the mathematically grouped amount, and the tight date tolerance, you basically create a highly secure Venn diagram. The matching parameters are so tight that false positives become mathematically almost impossible.
It just completely filters out the noise. And this logic operates in reverse as well, right? The sources detail one-to-many logic, which is critical for customer lockbox deposits.
Yes, that's a huge time saver too.
So the bank statement imports a single massive deposit line, maybe under code 115. But in D355, that deposit represents 50 individual customer payments, paying off 50 distinct sales invoices. The rule just gathers the 50 F&O ledger entries and seamlessly matches them to the one massive bank deposit.
It automates the bulk of the workflow, yes, but there is a feature within the rule set that goes even beyond simple matching. It's the generate voucher action.
Okay, what does that do?
This is engineered for transactions that hit your bank account but do not originate in D365 at all.
Bank fees are the classic example here, right?
Yeah.
Every month, the bank deducts a $25 maintenance fee. It shows up on the imported statement with a specific code, let's say 698.
Exactly. And normally, an accountant has to spot that fee on the statement, manually back out into the D365 general ledger, create a whole new journal entry to record the expense, post it, and then return to the reconciliation module to match it.
So tedious.
Very. But with the generate voucher action, you bypass that entirely. You build a rule that says, if the system imports a statement line with code 698, immediately auto-generate a new ledger voucher, post the $25 to the specific general ledger account for bank fees, and instantly mark it as reconciled.
Now, if you are an auditor listening to this, your alarm bells are probably ringing. We are configuring an ERP system to write and post its own ledger entries without any human oversight. How does that possibly pass compliance?
I know, it sounds dangerous until you look at the guardrails. You are hard-coding the specific approved offset general ledger account directly into the rules architecture. The system cannot just decide where to post the money. It is strictly following a pre-approved financial routing path.
That makes sense. The Stone Ridge Guide also mentions utilizing this feature for external payments, like tax authorities.
Yes, that's a great use case.
Like if your controller logs into a Department of Revenue website and pays a state tax bill via a web portal, that cash movement didn't start in D365. But you can build a generate voucher rule that utilizes text string matching. If the rule detects the text, say MN Dior 553, anywhere in the bank statement description, it automatically generates a vendor payment journal in D365 for that specific tax authority vendor.
It's brilliant. The mechanism completely transforms the reconciliation process. You are no longer investigating exceptions. You are building an automated assembly line that resolves them for you.
Okay, so the data is imported. The complex many-to-one rules have run. The generate voucher rules have posted the bank fees. The general admission one-to-one rules have caught the remaining standard transactions. Everything is paired up. The final step is formalizing the period close.
The finish line.
Right. And consultants do this using reconciliation worksheets. But the sources highlight a massive user interface trap here that can completely ruin a month-end close if you aren't paying attention.
Yeah, the reconciliation worksheet is the actual arena where the period close is finalized. And there is a vital architectural best practice regarding how these worksheets are generated. Many finance users, they instinctively attempt to create a new worksheet for every single calendar day.
Which, on the surface, sounds logical.
Yeah.
Reconcile daily, keep the data clean, stay on top of the cash flow.
It sounds incredibly logical, but in practice, daily worksheets create an absolute nightmare regarding cross-day timing differences.
How so?
Well, consider a standard biweekly payroll. You post the massive payroll journal in D365 on a Friday, but the individual employee checks and direct deposits, they hit the physical bank account sporadically across Monday, Tuesday, and Wednesday of the following week.
Right, they trickle in.
Exactly. If you restrict yourself to daily worksheets, D365 will recognize a massive discrepancy on Tuesday. To force that Tuesday worksheet to balance, you are forced to post manual adjusting entries, only to reverse those exact entries on Wednesday when the rest of the checks clear.
You end up polluting the ledger with meaningless artificial adjustments just to satisfy a daily UI requirement.
Precisely. This is why Jordan Soderstrom's guide heavily emphasizes creating a single monthly worksheet. You continue to import your bank statements daily, but you house all of those imports within one overarching monthly worksheet folder.
So it just absorbs the timing differences.
Yes, a monthly worksheet naturally absorbs those cross-day timing differences without requiring a single adjusting entry. And at the end of the day, your auditors only care about the month-end balances anyway.
That structural shift alone will save controllers days of wasted effort. But let's talk about the trap, the Mark as Reconciled button. When you finish reviewing your matching in the worksheet, you click this button to permanently finalize the period. But according to the documentation, there is zero system validation on this button.
It is a profound quirk of the user interface. As of the current source documentation, a user can click Mark as Reconciled at any time. The system does not possess a hard stop.
Wait, really?
Really, it will allow you to finalize the reconciliation even if there are tens of thousands of dollars sitting entirely unaccounted for in the unmatched statement transactions column.
That is deeply concerning from a systems design perspective. I can click Finalize with a massively unbalanced statement, and D365 won't even throw a warning banner. How do finance teams protect themselves from accidentally finalizing a corrupt month-end close?
It requires strict human discipline embedded into your close procedures. The system expects the accountant to manually verify that the specific bank statement unmatched field explicitly reads exactly 0.00 before their mouse ever goes near that button.
Wow, okay.
Furthermore, you must verify that the unmatched F&O bank transactions, which should primarily just be uncleared vendor checks, actually reflect reality. You validate this by running the Company Unreconciled Details report prior to clicking the button.
So it's essentially a manual verification checkpoint at the very end of an automated process.
It is. However, if a user does suffer a lapse in discipline and clicks Mark as reconciled prematurely with an unbalanced sheet, the system architecture is forgiving. The action is not a permanent disaster.
Oh, thank goodness.
Right. It can be reversed by a system administrator clicking a secondary button to undo the reconciliation, which reopens the worksheet, allowing the team to fix the errant matches and try again.
Okay, well, that definitely lowers my blood pressure a bit. So what does this all mean? If we step back and look at the entirety of what we have covered today, mastering these specific mechanisms changes your entire relationship with the ERP.
It really does.
Understanding the architectural differences between an ER format and a DMF file, navigating the Tier 2 dataverse requirements, architecting smart many-to-one rules that utilize layered logic to prevent false positives, and surviving the monthly worksheet process. You stop being a manual data checker reacting to the bank, and you become a true financial systems architect, actively orchestrating how your company's data flows.
The transition from manual verification to automated logic is profound, and experience is truly the best teacher here. The most effective way to grasp the nuances of layered logic is to open a Tier 2 test environment, download a sample BII2 file, and physically build these rules.
Just get in there and break things.
Exactly. See firsthand what happens when you place a blind one-to-one rule above a many-to-one grouping rule. Watch the system fail, and then reorder the rules and watch it succeed.
That is the best advice we can give. Get your hands dirty in a sandbox environment. Thank you for joining us on this deep dive. As you go back to your day, whether you are configuring a new environment or just trying to survive the month-end close, think about that broken scale we talked about at the beginning. You no longer have to balance it by hand. You have the architectural tools to build a machine that balances it for you.
And, as you build those complex matching rules, consider the trajectory of where Microsoft is taking this platform with Copilot and generative AI.
Oh, that's an interesting point.
Right now, you are manually configuring the system to look for count 469 and group it with a one-day tolerance. But every time you establish those parameters, you are structuring historical data patterns. How soon will the system's AI analyze those historical unreconciled anomalies on its own, recognize a recurring text string offsetting to a specific ledger account, and proactively write its own generate voucher rule without human intervention?
Wow.
The rules you're building today are quite literally the training data for the autonomous ERP of tomorrow.